Okay, so today we're going through the next slides, which are the rhythm of time. Give me 1 second to set it up here. Okay, so the market has moments of intention and long periods of noise. Not all periods are equal. Price behave different is a competitive advantage. This chapter names and different times of getting into the market session and Asia session. And as always, timing your trades and being patient is extremely important as a retail trader. Why this chapter matters? Many traders trade at the wrong times. Like, let's say you trade when you're extremely tired because London Open is at midnight if you live in California. That's one of those things where it doesn't fully make sense, but sometimes opportunities just arise. Good setups fall in low liquidity periods. Sometimes you can go into a market if you're trading prop firms or live accounts with futures or Forex. You could get into the market at Asian Open at 3 p.m. and that would be Californian time, which would then lead you to a market that's open for. So if you have enough liquidity, you could place one contract and say it's going up or it's going down. And at the end of the day, before 1 o'clock the next day during New York close, you could have a position that's either positive or negative. So that's why it's really interesting on how much time you truly have every single day. But usually the market closes out for 2 hours, so you have 22 hours of the day to actually trade. Time filters opportunity. Understanding timing reduces overtrading. Precision improves with patience, which is always very important to time your trade specific windows, like usually New York session and London session have way more volume, but we'll get to that in a little bit. Time controls participation. Participation changes throughout the day. This is kind of one of those things. The Asian market has very low volatility, depending on which markets you're trading. If you're trading in Nikkei, there's going to be a lot more volume during the Asian market. But if you're trading other stocks from the USA, let's say NASDAQ and S&P, or you're just trading those two indexes, then you have way more volume those ways. Also, same thing goes for currencies. If you're trading the yen or the renminbi, you would have way more volume and liquidity during the times of the Asian market. But actually, that's not fully correct because they usually pair to USD, and there's more liquidity in London and New York. So increases when markets open, liquidity decreases when during off hours, which of course makes sense. Price behaviors adapt to participation, more to volume and stronger movements. Like this is probably an area like Asian market is accumulation right here. And then you see the distribution, which could be New York, and or actually London first, into New York after liquidity sweep, where then at the end hours we see them just pump it one more time, and then the next day we open up down here. Very interesting. Fewer participants create noise, and time explains reliability. Global market sessions. Markets operate across global sessions. The Asian, London, and New York sessions. Each session has a purpose. Behavior shift at session transition. Sessions context matters a lot because you can kind of go through the idea of accumulation, distribution, and manipulation during those times. The Asian session is lower overall participants. Slower. You kind of can just run with a trend. It's a little bit communist built, so it's also like hive-minded, where they just all trade kind of with less damage into the same direction, lower volume, less candles move, and it's a very easy market to actually kind of navigate. Breakouts are less reliable. Also, when you see the push up, let's say they go from 300 to 360, usually it kind of stops at like 330, pulls back down to 310, and then it pulls all the way back up to 360. So you have more time for less mistakes or kind of being incorrect in certain positions. So you can take a little bit more risk when the market is not as strong, but you should always find a good entrance at a lower level to actually buy and run with the trend. If it's bullish, to sell, and short when it's bearish, and just kind of slowly position yourselves for a longer position, because these markets go on for 9 hours, 3 until midnight, 9 hours. The New York Stock Exchange only for 6 hours, so it's way more time where there's not as many people in the market. London session characteristics. So the London session is way more volume. There's way more um, institution, which is one of those big things as well, where one can see that kind of changes and because there's more volume and more ideas of different hedge funds and other things as well. And they kind of are preparing for the next market, which is New York session. So they kind of position themselves, start stacking into positions. Usually liquidity sweeps happen, and that's why there's a lot more false moves. Then you get into the New York session, which are led by hedge funds and institutions and a lot of retail traders. So what happens is the volume increases, the movements are very stronger, there's a lot more breakouts, and the risk to reward also expands quite a lot. So you got to be more careful. Rather than having a very small risk to reward, you would kind of want to increase it and maybe even go into a negative risk to reward where it's like a 0.5 to 1 or so. So then you usually lose a little bit more on trades, but your win rate is higher and you can get more trades done. For prop firms, I would recommend that, honestly. The next one is kill zones. Nothing is really happening. And also different zones where there's a lot happening, like macro events like Q3 before the market closes, like 12 o'clock until the market closes at 1 o'clock, or 4:30 or 4 o'clock for the New York Stock Exchange. That's when a lot can occur, and then the market's of course done for the next 2 hours. So then when the market reopens, you see these huge fair value gaps that just get created out of nowhere. After weekends, you have that even more. Time-based probability. There's certain things that can occur here and there. Like for example, if you are trading the New York session and Trump says something about China or so, there's a higher likelihood that something market goes down. But the same news during China market, they kind of get more excited, so they actually usually go more bullish, which is very interesting. And time adds confirmations, entries improve alignment, patience increases expectancies, and waiting is a part of their strategy as always. But not to trade when I would say that's not always the best idea, because you don't fully know what's going on and a lot of people can take over in 1 second, and then the huge market pump comes in during Asian hours after 2 hours of the Asian market being open. Usually at 45 minutes prior to the next hour, you will see a lot more volume coming in and the market is shooting up for like 500 points and then liquidity sweeping in the last 5 minutes before the market actually opens. And sitting out is always good to protect your capital, and time filters bad decisions. Time and liquidity peaks at session open, sweep often occur at key times, just like a Q3 IFEG, which happens in the London time quite a lot. It starts breaking down after the first 30 minutes or 15 minutes after going all the way up to take out Asian highs or New York highs. Slowly starts dropping, and then there's a Q3 macro inversion that shoots it back up one last time. So you kind of want to take your first profit to kind of have a buffer for the day. Let that happen one more time. If it doesn't happen, you already have profit, which is a good day. And then it starts dropping all the way. Time forms over time. Breakouts matter more at key hours. Fake breaks occur in low participation, which is quite often because there's just one big volume that comes in out of nowhere. One institution comes in and just puts in a lot of money or starts just stacking up for the next few hours or the next session to open. And that leads to liquidity sweeps in those areas. And then from there, they just start selling all the way down, which then leads to a falling knife, which is very difficult to catch. Structure without time lacks power. Timing confirms intent, and alignment increases confidence. Time errors. Trading all hours equally is kind of one of those big problems I face because I like to trade a lot and look at my charts all day. So that's one I would not recommend, but it's good to kind of learn over time, like certain candlestick patterns and what actually can occur. Over trading during noise, like news and stuff, is also a problem because the news already came out hours before, unless it's a live speech of, like, for example, Trump. Then you kind of have that exact same thing as other people, but some insiders, of course, already know what's going to be said at these kind of interviews, leading to this news already being a headline. But for example, Dell, when he says 12%, or when he said Dell is a great computer, it went up 12%. So those are kind of things that can occur during live events. And then also thinking over time, you only have like 2 hours a day where you can truly trade very well. So it comes to fatigue and other things that kind of make your decisions worse, which is not a great thing. So that's why of a exhaustion period, which will then lead to your trading being worse. So discipline is always good, and closing your laptop over time. Institutional time discipline is time rules reduce errors, fewer trades, higher quality, execution is planned, waiting is strategic, discipline creates a consistency, and time controls behavior. So sometimes at the end of the market, they're all trying to get out of the market, leading to certain areas to be accumulation areas, which are actually just distribution. And then at the end of the market, when the market's actually closed for most traders, all of a sudden it starts pumping upwards or downwards. So that's why the last 30 minutes of the market are sometimes not the greatest to trade, but sometimes they have the most volatility as well. Every day is a little bit different. Key takeaways are time determines quality. So if you're better in certain areas, I would recommend trading in only that area, like only Asian hours or only New York or only London, and other things in those ways as well. You can kind of go through your statistics, like, okay, if you really know to journal every single day, you will see, okay, during New York time, I always somehow lose a lot of money, but during London, I always make a lot of money. And during Asia time, I also somehow make a lot of money. So then those are the best ones to actually trade in because you're the most comfortable with the lower volume compared to the high volume, quick movements. If you're false ones, you can completely liquidate yourself. Sessions shape behavior, kill zones refine execution, and patience increases probability. So staying inactive and managing your time correctly is one of the most important things. The rhyme of time is, and yeah, thanks for watching. I hope you have a great rest of your day. God bless.